Okay, so when we talk of taxation of companies engaged in oil and gas transportation, oil and gas business, I will not bore us with the theory. You read that on your own, the assignment. But I'll just quickly give
Ayo,
us
who is that?
some background and move on to the most important aspects. Because I want to make sure by Wednesday that we'll be meeting, we'll be done with everything that has to do with advanced taxation, and I can sleep properly and rest like a normal human being does. Not the one that I'll be sleeping and someone will be messaging me that I should send them, I should help them upload the video for class that they did not attend. So what is oil and gas what is oil and gas taxation all about? Before, we used to subject companies engaged in the exploration or mining of crude oil. We used to subject them to tax following the provisions of the Petroleum Profit Act, CAP, I think it's CAP P8 LFM 2004. However, in 2021, the tax authority, the legislative the legislative enacted a new law for the taxation of companies engaged in oil and gas oil and gas operations, which is what we call the Petroleum Industry Act of 2021. Under the Petroleum Industry Act of 2021, companies that are engaged in petroleum, what's it called? Companies that are engaged in petroleum activities are divided into two, or let me say three. Yes, three. We have upstream activities, we have midstream activities, and we have downstream activities. The upstream activities are those activities that has to do with the extraction, exploration, or mining of the crude oil, and those activities. And for companies engaged in upstream activities, their actions or their activities are regulated by a commission that is called the Nigeria Upstream Petroleum Regulatory Commission, NUPRC. They govern and regulate what transpires in the upstream activity. And when we say upstream, we don't mean companies that have upstairs. So we mean companies that are engaged in the mining and exploration of crude oil. For midstream activities are those activities that have to do with the conversion of the crude oil that is exported, or let me say transportation, conversion of the crude oil that is what? Extracted. So companies engage in activities like refinery, like Dangote refinery now, and all of those, they will be in the midstream level. While companies that are engaged in selling the refined products, companies that are engaged in the selling of the refined products, like all these filling stations you see, they are in the downstream. And that's why when you see a fuel attendant that say I work in the oil and gas, it's very funny to me, because you are no different from those that are working Now, I'm just talking about that too. Working in the filling station is a good job. So now, midstream and downstream activities is regulated by an agency called the authority. Is it authority? I forgot to know. But the agency is midstream and downstream Nigeria Midstream and Downstream Petroleum Authority, NMDPRA. And what they do, their own activity is to what? Is to coordinate and regulate the activities of companies engaged in downstream and midstream sector of the petroleum industry. Now, under the Petroleum Industry Act, what we are looking at majorly is the taxation of companies in the upstream. You see, for companies in downstream and midstream, they are treated like a normal company, like every other normal company. They are only subjected to what is it called? Petroleum company income tax. However, for companies in midstream, for companies in the upstream are subjected to what is it called? They are subjected to company income tax as well as hydrocarbon tax. Now, the company income tax computation is just like we have always been saying, but the hydrocarbon tax is a bit different. The hydrocarbon tax is what? Is a bit different. And that's the major thing we want to look at in this computation. Now, hydrocarbon tax, which is the tax introduced by the Petroleum Industry Act, is a tax that is levied on companies that are engaged in what? Upstream petroleum activity. And it is payable on actual year basis. It is payable on actual year basis. It is charged on actual year basis. Payable on a monthly basis. And the payment period is in 13-month installments. What do we mean? If a company is engaged in upstream petroleum activity, first thing first, all companies engaged in all companies in the oil and gas sector, I mean upstream now, must end their reporting date on 31 December. That one is non-negotiable. If you are in the upstream sector, you must end your accounts 31 December. They are this thing. What am I saying? When they end their account 31 December, why would they? What happens? The essence of ending their account 31 December is to make sure they all have a uniform accounting date. Now, the moment they end their account 31 December, they don't go to rest like you do. They must prepare an estimated report for the next year. Let's say 2023 now, they close the year, December. 2024, they must prepare an estimated returns for the year. That is, they will forecast what will be our revenue for 2024, what will be our cost of sales, what will be this, what will be that. With that estimate, they will calculate what their hydrocarbon tax should be for the year. Then whatever that hydrocarbon tax they calculate for the year should be, they will divide it by 12. They will divide it by 12. And that figure they get, they will start remitting it. They will start paying it as hydrocarbon tax every month. Starting from when? Starting from March. Starting from 31st March, they will start paying the hydrocarbon tax. So that estimated account or returns must be filed with the relevant tax authority, which is what? Federal Inland Revenue Service, on or before 28th of February of the new year. That is, if it the end of 2023 now, before 28th of February 2024, they must have filed their estimated returns. And by March 2024, they will start what? They will start, what is it called? They will start paying the hydrocarbon tax. If for any reason they feel like the estimated account they did is no longer their reality, they have to prepare a revised estimate and recompute their tax liability based on the revised estimate and start paying based on that revised estimate. Till that's what they will do from that March till next year February. Now by next year February, they would have paid the 12 months hydrocarbon tax. However, it is because the accounting date is 31 December, on or before 31st of May of the following year. Now, we said 2024 is the year we are considering. On or before 31 May 2025, they must have prepared the final account for 2024 and audit it. Then based on that audited account, they will now calculate what should be their actual tax liability. The difference between the actual tax liability and the 12 installments they have paid so far is what we call 13th installment. That must be paid on or before 31st of May of that year. But if they have already paid more than what it is, then they will get a tax refund or a tax credit for it. That's that on hydrocarbon tax payment. Now, as you know, there's penalty for late payment, and there's penalty for what? Late filing. There's penalty for late payment, there's penalty for late filing. Because payment of taxes is different from filing for those taxes. That's one aspect. Okay. As I was saying, another thing we need to pay attention to for hydrocarbon tax is the calculation of the capital allowance. How do they calculate capital allowance, or how do we calculate capital allowance for a company engaged in upstream petroleum activity? For companies engaged in upstream petroleum activity, the hydrocarbon tax.
Dada, come.
Hello, will you mute your mic, please? So, the capital allowance is calculated as 20% in the first 4 years of the asset, 19% in the 5th year of the asset, and after that, nothing more. The 1% is retained till the asset is disposed. What do I mean? If you are to assess a company for, let's say, 2027 year of assessment, if they acquire any asset in 2027, the asset will be in its first year. So the capital allowance rate will be 20%, just annual allowance. We don't charge the initial allowance, we don't charge all of that. Then, what was it?
You are talking about the capital allowance, the
Yeah.
20% and the 20%.
If for the same company that we are assessing for 2027 year of assessment, though, if the asset was acquired in 2026, meaning the asset was acquired a year ago, then in 2027 the asset will be in its second year. So you see what calculate capital allowance at 20%. If the asset was acquired in 2025, the asset will be in its third year. Capital allowance rate is still 20%. If it is acquired in 2024, the asset will be in its fourth year by 2027. So you still charge 20%. But if it is acquired in 2023, then the asset is already in its fifth year by 2027. So you charge capital allowance only at 19%. But after that, if asset was purchased in 2022, 2021, 2020, or any time, the capital allowance rate will be zero. Is it clear? Is it clear?
Yes, sir.
We are trying to.
Okay. Okay, let's do it this way. Someone should first take us to question 5.
Question 5. Bonga Exploration and Production Company Limited has been operating in Nigeria for a while and filed its 2025 tax estimation on February 2025. Due to operational dynamics, the estimates were revised in July and November of same year with the following results. So we have February 2025 initial estimate $720 million. We have July 2025 first revision $428 million. We have November 2025 second revision $510 million. Required A. Determine the monthly hydrocarbon tax payable based on the annual estimate stated above. B. If the actual HT for 2025 accounting period is 542,150,000 542,150,225 naira $225. Compute the 13th installment payable if any. C. What is the due date of filing HT estimate? D. What is the due date of payment of 13 installments?
Okay, thank you. Even though no question has gone in this direction before, it's just necessary
I have a question.
Ask your
I
question.
have a, okay. Based on um the monthly tax, the
Mm,
HCT monthly tax, by said it is paid on actual year basis. And then you said the tax is paid on prediction. Like I don't understand. Is it that they make payment on a projected value or on the actual transaction itself?
okay. This is a business. You want to pay tax on 2025 transaction in the same 2025. You already know accounting is historical in nature, right?
Okay.
Meaning before we can know what actually transpired accounting wise in 2025, 2025 must have come to an end, abi?
Yes.
Mhm. But because the tax is to be paid on actual year basis, then they will have to do
Mm.
like an estimate. They will have to do an estimate. It is that estimate they will subject to tax. And when their final becomes, when the actual becomes available, which is in 2026, they will now pay the 13th month installment to make up for the difference between the actual and the estimated.
Okay.
Is it clear?
What if, yes, but what if from the estimation and at the end of the accounting period, they now observe that they have overestimated that the estimation is more than the actual this thing. So will there be anything like a tax credit for the company on
That's
it?
why you should come to class early. I made mention of it. There will be a tax credit or a tax refund for them.
Okay.
Ẹ pẹ̀lẹ́,
I was in this class before you
ó
that
yọ,
you are previous.
ó yọ.
Get back to good doing listen to
Ẹ
my
tún ti ń yọ gbófà. Ẹ sọ pé you were in class before me. Ṣẹ́yìn lẹ ní líǹkì ni? Ṣẹ́yìn lẹ ṣí kíláàsì?
I beg, I'm not just time this night.
Even Madam Elizabeth got to this class before you. Wọ́n sọ pé àwọn ti débi láti gbà o. Okay, determination of monthly hydrocarbon tax payable based on annual estimates for 2025 year of assessment. We'll have what? Initial estimate $720 million divided by 12, and that will give us how much? Let me put a caveat at this point.
60,000.
If you know big figures used to scare you, if you know you are scared of big figures, it is better and advisable you back out from this class, because here is money that even me myself have never seen before or heard of before in my life. Will be calling. We can be calling 120 billion. I don't have it, so don't come and meet me at home. I'm just working with the figure.
Oh,
Now, in July 2025, there was a first revised estimate, Abi. What this means is that we'll be paying 60,000 per month for hydrocarbon tax. But by July, we'll have to revise our payment. What is the revised tax based on the estimate now? It's
428.
But we would have paid 60 million for some months, Abi. The 60 million payment would have started in March. Would have paid March, April, May, June. That's 4 months, right? We'll say 60 million multiplied by 4. If we have paid 4 months out of the 12 months, it will be remaining what? 8 months. So with that, what will be our monthly payment? What will our monthly payment change to? Hello?
2,500. 23,000. 23,500,000.
Emma, we understand. People only my file the close door. Kò jẹ́ ṣe pẹ̀lú calculator tẹ bọ́ wà class tó wà lọ ń gbóná.
Olúwa o.
Ẹ má tẹ calculator ní calculator ju o. Tó bá gbà lọ́wọ́ yín lẹ́sàn kọ̀ lámì lè bá yín bẹ̀ o.
Am I from? You will get another one.
Ẹ pààyàn fún mi ni.
Must I pay for you?
Revised estimates, the estimated tax should now be 510 million, Abi. But they paid 60 million for 4 months. And they would have paid 23.5 million for another 4 months. Because that's what? July, August, September, October. That's 4 months also. But it's just coincidence that it's 4 months. Oh. Don't go to exam and say, okay, I said it should be 4 months. So you use 4 months. Oh. So what would that give us?
So what are we multiplying by 4 now? Addition of 60.
And because it's the same for 4 months. Or is it clear that way?
So we are dividing by how many now? By 2. November, December. Abi? 5. And Mr. Goodness.
Yeah, you divide it by 4 because it will be remaining 4 months for the year, Abi. You know, 12 months, we've paid this one for 4 months, we've paid this one for 4 months. So it will be remaining 4 months to the end of the year.
44 million.
The initial payment did not the accounting or when they started making the payments, it was not in January.
Mama, and you said you've been in this class since.
Yes, now because what we have here now,
You said you
November.
start paying in March now. The initial estimate will be filed in February.
Okay, sorry.
But
44 million.
Etí méjì ní kẹ́ máa mú wá class, ẹ má mẹ́yọ kan wá.
ẹnu yìí ni àfi bíi I deserve my comment.
Better you reserve it because on the 18 yìí jìnnà gan kò sí nǹkan tí ò lè ṣẹlẹ̀ kan ní 18 tó tó.
Kò sí nǹkan tó máa ṣẹlẹ̀.
Gbogbo fídíò tó ń jọ yín lójú yìí mo lè bring down channel yẹn líle láàrin èmi sọ́la.
Ẹ tó bẹ́ẹ̀.
Ok,
Ibi tó ti ń
dánwò ló
sọ̀rọ̀
ti
lórí
yàtọ̀ bẹ́ẹ̀.
lórí copyright ẹ̀.
Now, computation of 13th month installment. And when do we say this 13th month installment will be payable? May, 31st May of the following year. Because they will pay the installment up till February, the account should be ready by May. That's when they will file and pay it. So, actual HCT is how much? $542,150,225. Less hydrocarbon tax estimates paid. What are the estimates paid? March to June, they were paying 60 million. Abi? Yes. Multiply by 4. That is how much?
240.
240 million. Okay. July to October, 23.5 million multiplied by 4. That will give us how much?
94
million. Then November to February 2025, they will be paying what? 44 million times 4. That will give us how much?
176 million.
Summation of everything.
$510.
It must still give us back the 510 because all we did was to walk back to make sure what they paid is the estimated figure. So with that, what will be the difference? The difference is 32,150,225, and that is the 13th month installment payable. And what is the due date of filing hydrocarbon estimate? 28th February of the year. What is the due date of payment of 13th installment? 31 May of the following year. That is that.
Sorry, Mr. Good, how did we get the due date for payment in 13th installment? Like, how did we get the name?
The due date is a provision of the law. Motisol, I've said it. Is a provision of the law. The estimate must be filed latest 28th February of the year. The start payment, instrumental payment of the tax from March. They pay from March to February of the following year. And the final returns, the actual returns must be filed. And the 13th month installment must be paid on or before 31st May of the following year. Is it clear now?
Yes, sir. Thank you, sir.
Ẹ pẹ̀lẹ́. On the 18th fẹ́ tó gbogbo eléyìí máa ti tán. Ìgbà yẹn gan lè yọwọ́ ẹ̀ṣẹ̀ tí mi ta bá pàdé ní títì. But for now, nobody must try that with me. Kò yé? Ṣó yé? Kò yé?
Yes. You can continue, sir.
Even if you don't tell me, I'll still continue. Where is that illustration on?
Good evening. I'm just calling in.
I don't know if the evening is good. Because you came late to class, you are saying good evening. If the evening is bad, you would have come tomorrow, have you? Illustration one, Jare.
Wow, illustration
What
one.
topic is this?
SPI.
Introduction to education.
SPI.
As you
Don't
CPI.
mind.
illustration one,
CPI.
read the question.
So good.
The
You started
following
PIE without me, and
information
I was the one that asked for this class.
Jẹ́ kọ́kọ́ mute ẹ̀ náà, ó ti ń pariwo sínú kíláàsì yìí. Ó yá, mo ń gbọ́.
Wow. The following information was extracted from the account of
Raman Oil
account
Limited.
Man Oil Limited for the year ended 31st December 2023. We have year of acquisition, we have QC, we have the value. 2019 we have plant and machinery 18,900. 2020 we have tangible drilling costs 17,600. 2022 pipeline and storage tank 19,000. 2023 building 15,400. Required. Calculate the annual allowance for 2023 year of assessment.
So to calculate capital allowance, like I told you, the trick is very simple. Calculation of capital allowance for 2023 year of assessment. Kò gba thinking rárá. What do we do?
Okay,
The
even the capital is on actual year basis, Abi.
Yes, we don't charge initial and annual here. Everything is just annual allowance. So they've given us the year of acquisition of the asset. They've given us the type of the asset. Under Petroleum Industry Act, we are less concerned if the asset is furniture and fittings or motor vehicle. But mind you, the asset that will be charging this way is asset that has to do with what's it called though? Petroleum activity. So if they have an asset that is not for petroleum activity, you know, the capital allowance for that one cannot come into the petroleum, into the computation of hydrocarbon tax. So the capital allowance for those ones will be computed on that based on the company income tax rule. Ẹ pẹ̀lẹ́.
Sir, can you repeat what you just said now? Sir.
I said this capital allowance we are talking about, that only annual allowance is 20% for the first 4 years, 19% in the 5th year, the 1% is retained, is for QC that are for petroleum activity. If the QC is not for petroleum activity, the capital allowance should have been based on the provisions of the Company Income Tax Act. But these ones that are already here, it is whatever we calculate here, we'll also go and use in the Company Income Tax. Not that we'll say we'll recalculate it again. What is the cost? 18,900,000, 17,600,000,
19,000.
15,400,000. Now, capital allowance rate. Then the amount. Capital allowance rate will be what? First, we are computing for 2013 year of assessment. And when was this asset acquired? 2019. So you say 2019 will be the first year of the asset, 2020 second year, 2021 third year, 2022 fourth year, 2023, which is the year we are assessing for, is the fifth year of the asset. And in the fifth year of an asset, the capital allowance rate is what? 19%. The second asset was acquired in 2020. 2020 is the first year, 2021 second year, 2022 third year, 2023, which is the year we are assessing, is the fourth year. In the fourth year of an asset, the capital allowance rate is what? 20%. The next one was acquired in 2022. 2022 is the first year, 2023 is second year, 2023 is the year we are assessing and is the second year. So the capital allowance rate will be what? 20%. This one that was acquired in 2023 is still in first year, so it will be what? 20%. Oh yeah, give me the figure. Kill it to Shuba Mimbi by.
MIT figure, please. Me, I don't understand.
Don't worry. It's not for everybody to understand.
No, Mr. Goodwill, hold on. Let me see if I get what you're trying to explain. For plant and machinery, it was acquired in 2019, Abi, and we are assessing for 2023. So your counting is now 2019 is the first year, 2020 is the second year, 2021 third year, 2022 fourth year, 2023 fifth year. So that means because we are assessing the year 2023, the asset is in its last year, right? That's why we have that 19% there. Is that it?
Yes. You are right.
Are you sure?
Sorry, oh. Are you sure?
You are doubting me.
Because you might be pulling my legs now.
Pulling your leg, you can. Ejo
Oh yeah,
ni mi
wait.
o ba mi o.
We're saying that.
So,
Then for the second asset, hold on. For the second asset, for the tangible drilling cost, the year of acquisition was 2020. So from 2020, 2021, 22, 23, 20, 20, 21, 22, 23. So the asset is in its fourth year. And the fourth year, right? So that's why we have 20% there. Okay, I think I'm okay. Now I get it. Thank you.
Ẹ pẹ̀lẹ́. Ṣé mo pé 3 hours
sorry.
ní gbogbo nǹkan tá à ń sọ yìí?
Sorry, oh.
Yeah.
My question is, these assets now, what about for the other years? I thought this rate we are starting with at the current year, are we using the tax rating down value to continue the calculation? So
Tax
because
is in down value.
I'm still here, we use the cost.
Baba, we are using cost o. Cost. Capital allowance is
For
calculated
capital
on
allowance.
cost basis.
So we have 13.
What about the other years?
30% of the cost.
What about the other years? The capital allowance for those years?
Any year you are calculating is on cost. The rate is what will do the justice to it.
Okay. Oh.
You know, when we want to do it, you just say, we are here till 8 o'clock. Before I know it, you will have carried your bag. You are gone.
So we have 13991.
991, okay.
Yes, now 13991. Okay, but that's 391. So what do you expect now?
You explain to me what I will expect. Ladies and gentlemen, that's that on what's it called? On capital allowance. The next thing that is important for us to do is production allowance. And production allowance is an allowance that is granted Ta nìyẹn? For production allow Christopher, what is it?
No, mine has been off since I just removed it. Don't worry,
Better.
I'm fine.
Not I will cut off the hand. But do you understand your question now?
Yeah, I get the question. Let's continue. If I have any other question, I'll raise. Thank you.
Okay. Production allowance, or you sometimes see it as petroleum allowance, is an allowance that is granted based on the production of the company. You know, when the company before under the PPT regime, we used to have what we call petroleum investment allowance, but that is just an allowance that is granted on QC acquired in that year. But now government say no, will not be giving allowance because you bought a QC that year. Rather, we'll be giving an allowance based on your volume of production. That's production allowance. And the rate differs depending on where you are operating. For those that are working with conversion contract, their production allowance is lower of $2.50 per barrel or 20% of the fiscal oil price. Before I do this, let me explain fiscal oil price and fiscal oil value. Yeah. So when we talk of fiscal oil price and fiscal oil value, fiscal oil price is the price the commission, which commission are we talking about? Nigeria Upstream Petroleum Regulatory Commission, NUPRC, has set for the sale of crude oil. Take for instance now, the NUPRC can say this year crude oil should be sold for $100 per barrel. That figure is what we call the fiscal oil price. You know, when we say fiscal is relating to government. So that's the price government has set for companies to sell their oil. And the fiscal oil value is just the fiscal oil price times the volume. Fiscal oil price times the volume. However, when we want to compute and we are giving fiscal oil price, we compare fiscal oil price with the actual oil price and choose the higher to determine the taxable income from the sale of crude oil. We pick the higher of the fiscal oil price and the actual oil price to determine the tax liability. So that is just that about fiscal oil price. Now, as I was saying on the production allowance, if the area of operation is onshore area, onshore is on the land, if where they are extracting the crude oil is on the land, then the production allowance will be what? $8 per barrel or 20% of the fiscal oil price. But it is subject to what? To 50 million barrels. Anything in excess of 50 million barrels will be baited outside. Anything in excess of 50 million barrels will be what? Will be charged at $4 per barrel, $4 per barrel, or 20% of fiscal oil price, whichever is lower. For shallow waters, that's water within the depth of maybe 100 meters. The Those ones, the production allowance is 8 million per barrel or 20% of fiscal oil price, but to a maximum of 100 million barrels. Anything after that will be at what? At lower of $4 per barrel and 20% of fiscal oil price. For deep offshore and frontier, those are those that work on 200-meter water depth and above. Their own production allowance is 8%, $8 or 20% of the fiscal oil price. But it is capped at a maximum of what? 500 million barrels. Okay? So that is that. Let's just quickly see. We can do illustration on that. Will someone take us to illustration 3? Oh yeah, read question 3. Oh.
Pillar Oil Upstream Petroleum Company Limited was established several years ago, and the following data for crude oil production for the year ended at 4 December 2023 is provided in the schedule below. Assume all figures are right. A. If it should be noted that the fiscal oil price advised by the Nigeria Upstream Petroleum Regulatory Commission (NUP) NUPRC is $125 per barrel. B. The company disposed all the crude produced in the current year at the fiscal oil policy advised by the Commission required compute the fiscal value of crude oil sold for 2023 year of assessment. B. Compute production allowance of 2023 year of assessment.
Okay, so we'll have what? The first thing is to calculate the fiscal oil value of the crude oil. So we'll have pillar oil. Upstream petroleum company limited. We have area of operations. We have the current year production. We have fiscal oil price, and we'll have the fiscal oil value. So what will it be? We have the area of operation to be what? Onshore. Current year production 7.5 million. Fiscal oil price $125. And with that, what will be the fiscal oil value? The next one we have shallow waters, 35.75 million. Fiscal oil price 125. The next one we have is deep offshore, and the volume is 47.2 million. Fiscal oil price 125. So here they did not separate that the one that started here or there are different types of crude oil. Just everything at $125. So what do we have? This should be 937.5. $4468.75. $5,900. So the fiscal oil price in dollar is how much? Can you guys hear me? I don't tell me my network is having issue.
We are with you. We are with you. We can
We
hear
are
you.
hearing you. Just that this one is difficult to.
Difficult, okay. We never even start.
Okay. 11306.5.
What we've only done is to calculate fiscal oil value. We've done the fiscal oil price times the production. You know, in the table they gave us per year production. We don't need per year production in calculating what our fiscal oil value. Because by saying fiscal oil value is what we want to calculate, we mean we want to know what is the value of what they produce in the current year. So we don't need the per year production, but we need the current year production. We also don't need the cumulative also. Now, and they've given us the fiscal oil price to be what? To be 125. If they are separated it that okay, maybe for onshore crude oil, this amount, shallow water, this one, this amount. But here they just give us 125. That's why we use 125 also. And if we multiply fiscal oil price times volume, we'll get the fiscal oil value. Is it clear now?
Yes, please. I can't even.
The
I'm
next
even
thing,
struggling to.
huh?
I can see that so your screen is coming and is going. So I think it's just from my end alone. I'm still struggling, though, but I'm
It's
following.
from your end alone. Who is that?
Chris, Chris.
Pastor, go and buy better thing. So to calculate production allowance, we'll have area of operation. Workings. Then amount. You mean this stuff me now. Onshore. For onshore, remember we have said that production allowance is granted on the total production or cumulative production as at the end of the year. So we have what? Cumulative production for onshore is 60.5 million. And we say for onshore, the production allowance is done as what? The first 50 million. For the first 50 million barrels, please, can that person mute his or her mic, please? For the first 50 million barrels, it is lower of $8 per barrel, which is $8 times 50 million barrels, or 20% of fiscal oil price of 125, or what? Of the 50 million barrels. Then the remainder, which is 10.5 million barrels here, will be what? 4 million per barrel, or 20% of 125 figure. Hello?
I'm with you.
For shallow waters, we say it is the first 100 million barrels.
So the
That
first
will
one
be
you have for $400.
400.
That's for
We'll have lower of
0.2.
what? The same thing. $8 times 100 million barrels, or 20%
1 to 15.
of $125 of 100 million barrels. 1,250. So this one, which one is lower? $400. We bring it here.
42. We have 42.
42.
262.5. 262.5.
So what do we have? The lower here is 42, Abby.
42, yes.
But it will be dollar in million. Do we understand?
We'll
Do
go
we?
to the 800. We have 800. We have 800 there. 25. We have 2,500. The lower is 800.
Lower is 800.
Mm.
Then the next what? 25.75 million.
This one.
$4 times the 25.75 million barrels, or 20%
We have 20.6. We have 20.6.
20.6.
643.75.
Are you
643
sure?
point. Yes, ma'am.
I did this first one. I'm getting something
That
else.
the
So
first one I
I'm
got
getting one okay.
103.
Àwọn tó ní calculator ti dé. Òun ló fi wọ òlu. Mọ́tò ẹ̀wọ̀n lọ bá wá. Fortune.
So we were in SFM class.
I thought it's money for calculator that you got that did not make you have transport fare. You now follow the trailer bringing pepper to Lagos.
Oh.
Deep
This is not what I called.
Deep offshore, we have what? First 500 million barrels. Lower of $8 times 500 million barrels, or 20% of times what? 500 million barrels.
4,000.
Next, 447.2 million. 4,000.
500. 5,500.
$4 times 447.2 million, or 20% of 125. Figure. Figure.
7.2. 180. 11,180. For the 20%. Oh, no, the second one. Not that one. Yes. 1,180. 11. 11,180. It's not 1,180.
1788.8.
1788.8. So the lower here is 4,000. The lower here is 1788.8. So what's the summation? Is it clear? What's the summation?
7133.8. 7133.8.
So that is the production allowance in dollars. And even they gave us exchange rate now, we'll now convert it to naira. But that's that. Is it clear?
Oh, it's not clear. Please wait.
Okay. That's the diagram. It should not be clear to everybody.
Okay,
The next thing is what? Is royalty calculation. Royalty. Àwọn wo leléyìí? Royalty. Like we said yesterday, When you are taking government resources, you have to pay. In this case, royalty for oil is paid to the government. Okay? Royalty is calculated on two bases. We calculate royalty based on price, and we calculate royalty based on production. For calculation of royalty based on price, it is with a formula we determine the royalty rate. And the formula is just the higher cost minus lower cost over higher cost minus actual cost equals to higher rate minus lower rate over higher rate minus local rate minus actual rate. So what do we have? Now, according to the Tax Act, where the price is at $50, the royalty rate based on price is 0%. Where the price is at $100, the royalty rate is 5%. Where the price is at $150, 10%. So if we are giving any fiscal price, just like in this case, in the example we are doing, that we have fiscal price to be $125. What we'll do is to get the royalty rate for $125. So to get what will be the royalty rate, we'll use this formula. 125 is falling within the range of these two. So the higher cost will be what? $150 minus the lower cost, $100, over telling that the higher cost is 150, actual cost is what? Actual is 124. The higher rate for that $150 is what? Higher rate is 10% minus 5% over 10% minus X. So we'll have what? 50 over 25 equals to 5 over 10 minus X. We'll cross multiply, and that will give us what? Okay, we have what? 50 into bracket 10 minus S equals to 25 times 5. 125. So X will be what? 375 over 50. And that will give us what?
7.5.
7.5%. So it is this 7.5% we use to calculate the royalty based on price. So if our fiscal oil price is $80 now, our higher amount would have been what? $100 minus lower amount $50 divided by what? Oof. 100 minus what? 80 equals to 5 minus 0 over 5 minus x. So we have what? 50 over 30 equals to 5 over 5 minus x. 50 into bracket 5 minus 5. So equals to 150. So we have what? 250 minus 50x equals to 150. X will be equals to what? 100 over 50. And that will give us what? No.
So
Okay, so what do we have? 250 minus 50x. So we'll have this to what? 100 divided by 50. That will give us what?
it's supposed to be 50 over 20.
20. Ah, that means this is wrong then. So this should be 100. So that means the numerator here should be 150. Okay, what do we have? X will be what? 3%. Abi? That's how we calculate it. But if we now want to calculate royalty for this thing now, we can come back to this one and say royalty rate then the amount. What will be our royalty rate? Don't forget, it's royalty based on what? Price. We've calculated it to be 7.5%. So what you just do is 7.5% multiplied by the what? So what do we have? So what I'm saying in essence is that royalty based on price is calculated on the fiscal oil value. And that will be what? 269,325.
264.
264.
Then
I'm doing
2.
it. I'm doing it at the wrong place now. You can't calculate royalty on QC now. I wanted to do it on the illustration we did earlier. This is it here. Okay. What we'll do is royalty rate. So what do we have? Royalty rate, then the royalty amount. 7.5%. Okay, so what do we have? Figures. Figures. So the next, it is what? Times 937.5. That will be
70.3125.
70.3125. The second one, okay?
335.16 approximately.
335.16. So let's just make the first one 2 DP so that everything will be on the same level. Number 3,
442.5.
442.5 what?
Just 5.
So what's the summation? Summation
847.96. Abi.
847.96. That's royalty on what? Royalty on based on price. Like I said, we also do royalty based on production. But for royalty based on production, it is based on this table that we are giving here. I don't know how you want to do it, but though they never tested a situation where they will say students should calculate royalty amounts or all of these things themselves. I'm only showing us all of this. So if you see something like it in exam, you will not say they did not teach you. So for royalty based on production, we follow this table. So I'll just rewrite the details I have. Calculation of royalty based on production. So we'll have what? We have area of operation. We'll have current year production. We'll have fiscal oil value. So let me first leave it at that. I'm still coming to it. We have onshore, shallow waters, and deep offshore. Okay, so what do we have? 7.5 million, 35.75, then 47.2, and their value is what? 9375. 4466.75. This one is what? 5,900. Now this is just their fiscal oil value. Having done this, the royalty rate, as you can see from the table, the royalty rate is based on their daily production. So first say what's their daily production, and how do we get their daily production? Their yearly production divided by the number of days in the year, which is what? 365 days. So what will that give us, please? Hello? Hello?
So I did not get what you said.
We have to calculate, as you can see from the table where we are getting the royalty rate from, the royalty rate is based on production volume in barrels of oil per day. This column here. So to do that, we need to get what is the daily production per day. So what daily production will now be the current year production divided by 365. So you do 7.5 million divided by 365, and that will give us what?
0.0.
It cannot be zero. It cannot be zero. We should use the figure in full, please.
Okay, sir. 2547.9.
For the first one,
Yes, sir.
20 what?
2547.94.
Don't worry. 2547. The second one,
97,945.
97,944.
945, not 944.
945.
129,315.
So to now get the royalty rate, if this is an onshore operation, this is onshore here, and the production per day is 20,000. They said for production greater than 10,000, the PIA rate is what? 15%. So we'll say 15%. These shallow waters, This is shallow water. For production above 10,000 per day, the rate is what? 12.5%. For deep offshore is waters above what? Above, what is it called? And that is what? No, it's not here. Okay. Oh, this is beyond what 200-meter water depth. And because our daily production is above 50,000, we do 7.5%. What will this give us, please?
$140.625.
What did you do? 15% of 937.5.
937.5. Yes, sir.
140.625. Uh-huh.
558.594.
558 point what?
0.594.
Uh-huh.
442.5.
442.5. Summation. What do we have?
1141.719.
So that is on production, royalty based on production. So basically, those are like the key things we need to know before we go into solving a complete question. So I might have to call it a time at this point. Then on Wednesday, when we'll be meeting to discuss further, we will now be looking at the allowable and disallowable expenses. I will explain cost price limit ratio, and we will also solve questions that has to do with calculation, I mean examinable question on PIA, and we'll call it a time. Ladies and gentlemen, it is on this note I want to say I hope I've been able to convince and not to confuse you on this taxation. Have I been able to convince you? I hope you have learned one or two.